Good morning, traders. Good morning, traders. Today we want to discuss how to use the wave theory like a market analyst. Okay, how to use the wave theory like a market analyst. All right, as a market analyst, you will be forecasting the markets. All right, setting the price targets, all right, warning smart investors when they should buy, when they should pull out of the markets. As an Elliott wave trader, you are to a certain degree, all right, a market analyst, doing your own thing, forecasting the market for yourself, trying to understand what is likely to take place in the financial market. The financial instrument that we are about to analyze is called Gilead Sciences Incorporation. I hope my pronunciation is correct. If not, well, it's your time to correct me in the comment section. The EPIC is GILD, Golf India Lima Delta. This is a Nasdaq 100 component. And we're going to start, all right, using the Elliott wave like a market analyst to try to have a bit of idea, okay, what is likely to take place, all right, for this stock. By the way, I need to remind traders that this video is for educational purposes only. It's neither a solicitation or an offer to buy or sell, okay, Gilead Sciences Incorporation. All right, so following our guidelines, looks to me, looking at this chart or the yearly chart, looks to me that this is the first wave of a bigger cycle. All right, I use the yearly chart as a bigger cycle, and the third Elliott wave somewhere here. Now, one thing I need to say to traders that are checking that are counting Elliott wave on the yearly chart, you need to be aware of the shadow on top of the candlestick bar and also the tail, because those shadow, all right, on top of the candlestick bar and the tails sometimes, okay, will correspond to an Elliott wave, an Elliott wave, okay, an Elliott wave, all right. So though it looks like this is the third Elliott wave all the way here, and this is the fourth Elliott wave, all right, it is not, because of okay, the shadows, all right, on top of this candlestick bar, because the price went up to X and then pulled back again, all right, somewhere here, and here it went down a bit, all right. So you need to take those candlestick into consideration. So all I will say, I say first wave, second wave, third wave somewhere here. Let's go now to the monthly chart to investigate those candlestick bar. All right, that's what we want to say here. All right, so don't get into the trap of thinking that okay, this is the third Elliott wave and the fourth Elliott wave on the yearly chart. All right, it's not. You need to investigate, all right, those okay, tail and shadow of those candlestick bar. All right, so we're going now to the monthly chart to find out what's going on there. And now it's clear to us this is the first wave, quite an impulse wave. Will you agree? Quite an impulse wave up to this point. All right, let's zoom into it a bit and see, because I don't want the video to be too long. All right, here it is here. Boom, 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 up. Okay, impulse wave. Now, what we are calling the second wave, you can see here, boom, boom, boom. All right. Okay. 1, 2, 3. All right. It's a kind of triangle here, if you agree, for the second wave. So I'll put it like this. But the low of the second, you see, it's quite, you see here, is, hold on please. Which one are you calling the low of the second wave, all right? So when we start applying a channel, we will see which one is useful to us, all right? Very important, all right? What is useful to you, that's what you're going to use. Okay, so this is the second wave, right here. I'm going to color it now into red. So market analysts will use the fundamentals and the technical to forecast the market. All right. So if you want to use the Elliott wave, the wave theory, like a market analyst, please do me a favor, try to combine the technical analysis with the fundamental. Do not use the technical analysis alone, all right? And then you are pretending that you are a market analyst. Because one thing that the market analyst hates is that they get it wrong. And you know, when they get it wrong, everybody will talk about it by all means, all right? By all means, they will talk about it the whole day, all right? So where is the third wave? All right, where is the third wave? Looking at these charts, all right, because I'm looking now, what's going on here? All right, you know, sometimes if it's not clear, that's what we are talking about. When we have a chaotic situation, when we have a complex situation, all we need to do is to find what? A stable data, all right, to find something that is true, yes or no? So this is how we will get to the bottom of where is the third Elliott wave. Is he ending here? All right. Or is he ending here? Or is he ending here? All right. So with that information, when you face the challenge like this in your wave count, try to find something that is true. So let's see, with the chart, like I told you before, price went down. Okay, price went up. Okay. Price came down, yes or no? If you disagree, let me know, all right? Here we are. But you can see that it came down in 5 waves. 1, 2, 3, 4, 5. And those waves are overlapping. So this is a corrective wave. And what is coming through my mind is ABC correction. All right? So personally, it looks to me that is a bit messy. All right? Flat correction here. All right. So with that, one more thing, one verification that I can do, all right, is that I will apply Fibonacci extension to this supposed to be the 5th wave. Well, the reason why do we need to do that? Because we want to know where is the 138.2% Fibonacci extension level. It's somewhere up here. But you can see that I placed my Fibonacci extension to the tail of the candlestick bar. What I'm going to do, I'm going to adjust it now to the closing price, because why? Other trader may apply the Fibonacci extension ladder. So applying it now to the closing price to this session here, our 138.2% Fibonacci extension level is now here. It looks to me that those who were trading this, is it Guy Lead Sciences? Guy Lead Sciences or G Lead Sciences? Let me know, traders. All right. So here we are. So looks to me those Elliott wave practitioners were applying the Fibonacci extension to the closing price instead of to the high and low. So I will accept this one as a flat correction, which is a little bit messy. We can see the internal wave 1, 2, 3, 1, 2, 3. You will see that sometime when the A part of the flat correction will be just one move down, boom, and then the B part will expose the 3 wave 1, 2, 3. You will see that sometimes the A may come down very fast, boom, like this, and then you will see 1, 2, 3. All right, sometimes you will see that, which means you may not see the internal wave of the A part of the flat correction. So by doing this verification now, it's clear to me. All right, you may disagree. All right, feel free to disagree. It looks to me, I will label this move, all right, this move here, the 5th Elliott wave, because of the stable data that I have here. 1, 2, 3, 4, 5. First thing coming to my mind, ABC correction. Which one? Okay, the way you see 1, 2, 3. Now I'm thinking of the flat correction. All right. So this is what we are talking about. You have a chaotic situation. Try to find one thing that is true, one little truth, and then from there you try working it together. All right. It's like suppose you smash, okay, your computer and you want to put it together. All right. All right. And then you find the RAM, so you put the RAM to the side, you find the hard disk, then you put it to the side, and then that's how you, if you can find, all the pieces are just scattered, you can put them together, all right? That's what we are talking about. So the same thing sometimes when you're counting in your wave, this is what the market analysts are doing. The wave count can be challenging sometimes, can become complex. Now you want to find one piece of the puzzle that you can recognize, and then you put it to the side. Say, all right. This looks like an impulse wave. Why? Because it has been subdivided into 5 waves, and the waves are not overlapping. Here, as you can see, one piece of the puzzle that I found is 1, 2, 3, 4, 5 down, but they are overlapping. So I'm thinking, wait, hold on a second. This is, all right, ABC correlation. This is not an impulse wave, it's a correlation. You see, this is what you need to do, all right? So now we find the 5th wave, which is this one here. And now our wave count is making a little bit sense, all right? It's making more sense. All right? So you can imagine that if a market analyst begins, okay, an Elliott wave count or an Elliott wave analysis, he will spend a lot of time to make sure that everything is perfect. He will verify it. He will try to validate the wave count. But not only that, he will go to Google Finance and check the fundamentals, all right? The economy news relating to the financial instrument he is about to forecast or discuss with the smart investors. So he may come up with a good arguments when he is about to forecast the market. So you want to start adopting a mindset of a market analyst when you are using the Elliott wave, because what I have noticed that sometimes we can be a little bit arrogant, okay, in comparison to other traders when we say we know it all, and we are laughing. All right, you see sometimes so traders do mock other traders. Elliott wave traders can mock other traders. They can, all right, they can, they can, all right, because they know a few things that other traders do not know. All right. Here it is. So we get it now. Okay. Now it's becoming a bit clearer now. Yes or no? So you have to understand that a 2-4 Elliott wave. I mean, you may wonder why I sit in front of my computer every day try to talk about Elliott wave, because I'm passionate about this subject of the Elliott wave principle. All right. Now I remember the first time I started to use the Elliott wave. I was thinking, well, this makes more sense. I was thinking of a price action trading before. Here it is, the purest price action trading. And I can only focus on the price instead of the technical indicators. Talking about technical indicators, my friend, I have here the CCI period 30. And I recorded a video recently. I will mention that very fast. And the title of that video, which I recommend to traders to go and check out, is... the title is A Simple But Powerful CCI Trading Strategy One Can Use. A simple but powerful CCI trading strategy one can use. That video, we post it at Day Pro Traders YouTube channel. So the strategy is very simple. So a trader was asking me at 2-4 Elliott wave 2 channel to record more videos about corrective waves. So as I said to you, we will go deeper and deeper and we will get them. So one trick that you can use when the correction is beginning is to use the CCI period 30. All right, you see here, CCI period 30. You will see that when a CCI period 30 is declining like this, is sloping down or has a negative, slope. All right. If the price, you are looking for something, if the price break below a bullish trend line and you retest, you see here, boom, here it is. This can also help you to improve your corrective wave trading. Break below a bullish trend line, retest it here, that's a bearish trend setup. The next step is to apply a top-down trading method, a multiple time frame trading method, a different time frame trading method, all right, without ignoring the trading triangle. Now that it starts displaying lower lows, lower high, it's now aligning with the CCI period 30. CCI period 30 is going down as display lower lows, lower high. Now you want to sell it on the edge here. But this is where the Elliott wave trader will mock other traders. Because what we are doing, we are looking at the price structure. We are looking inside the price. We are surgeons, all right? We are dissecting the price. Or you may say we are inferring the price, the language of the price, the complicated language of the price. We are trying to interpret the language of the price. All right? All right? So the CCI30 can help us to trade the corrective phase. But now, as you see now, we know that 1, 2, 3, 4, 5 possible reversals at this point in time. So let's remove this and continue to, okay, hold on please, continue to, okay, use the wave theory like a market analyst. Right. Now that we have counted all our waves, first wave, second wave, which is a triangle, and then third Elliott wave, extended by all means, fourth wave and fifth wave, no Elliott wave violation, all right? The third wave is not the shortest wave because it's longer than the fifth wave at least, and the fourth wave is not overlapping the high of the first wave. Everything is working beautifully, and we see clearly that a correction is underway, and it looks to me that the correction is finishing here. But, you know, one of the mistakes that the Elliott wave practitioners are making, you see now, you say, oh, George, we are likely to have, okay, a new trend, a new cycle is likely to finish because the flat correction is completed. Don't get into that trap, all right? Don't get into that trap because you want to use the wave theory like a market analyst. A correction can be calm, a complex correction. Remember, I told you before about the 4 types of correction: the zigzag, all right, the flat correction, the triangle, and the last one is the combination. The combination of those first three correction: triangle and zigzag, zigzag and flat, or double zigzag, triple zigzag. A correction can become a complex correction. That's the 4th type of, okay, correction, the combination. So now sometimes we see like this, we say, all right, George, you said, I remember that video, you said it clearly, that you count down 1, 2, 3, 4, 5, and end of a correction. But a correction can become a complex correction and can be prolonged. Yesterday, I recorded a video that I will be posting at 248 Elliott wave. It's not there yet. And by the time I post this video, it will be there. All right. So when you are watching this video, you know that I already posted the video I'm about to talk about. Okay. Discover, that's the title of that video. Discover one of the advantages of the wave theory. Discover one of the advantages of the wave theory. In that tutorial, my friend, okay, a correction lasted. The financial instrument we were looking at is Amgen. Amgen is a pharmaceutical stock, an American pharmaceutical stock, EPIC AMGN, Alpha Mike Golf November. A correction lasted 11 years. Now, you get a message, all right? A correction lasted 11 years. So it's not because we have seen 1, 2, 3, 4, 5, all right? Some traders, remember this, some professional traders do not like the correction. They don't know that they don't like to trade the correction because it can be a little bit messy sometimes because of the combinations. So as you have seen it now, what a market analyst will tell clients is that this stock, okay, Gilead or Gilead, all right, a Sciences Incorporation, has a high chance to start a new trend. But you see, if you are talking like this, he will say also that, but there is something that investors should be aware of, is that the S&P 500 is in a 5th Elliott wave. So if the market starts going down, that will have a negative effect on this stock, though this stock has completed, okay, one leg of the correction. He will also say to the client that sometimes a correction can become a complex correction, which means a multiple correction may take place. A correction may last even 11 years. Check out that video, discover one of the advantages of the wave theory, so you may understand what I'm talking about here. So, but for ordinary traders that are trading, we see that we say definitely you're going to have a new trend, but it may not. It may continue to Okay, it may consolidate through this level 78.4 and 127.24. This one leg of the correction. A correction can become a complex correction. But now that this pattern is completed, all we can say at this point in time is that, okay, prior to bullish signal above $70.84 and prior to bearish signal below it. All right, price going down, watch the resistance level. All right, so use the CCI period 30, that may help you in your corrective phase, and pay attention to the price structure. All right. Now, I also recorded another video recently, and it's about the CCI again, and it's about how to trade a CCI hook trading signal like a pro. When the CCI D below the zero line and quickly return above it. All right. So we have now a double bottom chart pattern here. This monthly candle here, this one here, is not yet closed. Why? Because today is the 14th of November 2016. It will be closed on the 30th of November. So at this stage, if you want to play, we will play it for day trading. All right, looking for opportunity to buy as a day trader. Okay, and see whether it's going to push it up. Okay. For swing trader, one must wait for this candle to close first before we can make a decision. All right. So I don't want the video to be too long. I will stop here. All right. So we may continue and check whether we have a normal third area wave and so on and so on. But just to highlight, okay, to get your attention, so you may start adopting the mindset of the market analysts that are using the wave theory. If you have any question or suggestion, put in the comment section. And in due course, all right, I will record another video to answer your specific question. We are the TSTW24 traders talking about discover how to use the wave theory like a market analyst. Happy trading to you all and speak to you soon.